Now let's look at how we would record these adjusting entries in QuickBooks. In the manual simulation of a month-end process, we recorded the payroll tax expense and the appropriate liability for the FICA tax payable, the state unemployment taxes payable, and the federal unemployment taxes payable. In QuickBooks, we do not have to compute this entry because QuickBooks has already computed the employer's portion of these payroll taxes when we recorded the December 31st payroll transaction. So that means the first adjusting entry we'll record is the depreciation expense for the year end. To access the general journal, we click on Accountant and then select the Make General Journal Entries option from the drop-down menu. This will take us to effectively a spreadsheet. We make sure that the collect date is selected, and then we select depreciation expense from the drop-down menu showing the chart of accounts, and we select the appropriate account for accumulated depreciation for the credit. We've already computed the annual depreciation expense in our manual simulation, so we know that we can enter 3477,931 as a debit, and the same credit amount. We enter a memo in the appropriate column. And then select Save and New. As long as all of these fields are correct and you've verified them visually, you can move on to the next journal entry. In our case, the next journal entry is interest expense. Again, you would select account number 40800 from the drop-down menu as the debit and interest payable, account number 21000 as the credit, and record the appropriate amount that we calculated in the manual simulation, $162.74. Again, recording an appropriate memo. We review the transaction, ensure that the date is correct, and assuming it's acceptable, we select Save and New to continue. Now, QuickBooks recording of bad debt expense is a little bit different than the way we recorded it in the manual system. So to show you why, we need to take a quick diversion to the working trial balance, which is another option under the accountant menu bar. If we scroll down to the bad debt expense account, we'll see that we have a debit balance of $4,400. This takes into consideration the $1,500 that were already recorded in the bad debt expense account prior to the beginning of our simulation, as well as the $2,900 that we recorded when we wrote off that account. We want the total annual bad debt expense to be the $7,560.40 that we computed in the manual simulation. Therefore, the difference here Therefore, the difference between the expense we calculated and the $4,400 that we already have in the bad debt expense account for the year is $3,160.40. We record the debit to bad debt expense and the credit to allowance for doubtful accounts. Now, QuickBooks is going to demand that you enter a name for which account the bad debt expense is associated with. You can simply write off here. And again, once we've satisfied ourselves that the date of this transaction is correct, the accounts are identified correctly, the debit and credit is the amount we've calculated, we can select Save and Close. Now we have one more example of an adjusting entry to compute. It's a complicated process in the manual understanding aid, and it's a complicated process, well, slightly, in QuickBooks. So those transactions will be demonstrated in a separate video.